Yeah, next couple of days, like you really don't want to see us go through the lows. That's the big thing. So I was like a little freaked out last night because we started going back down. And like you really want to see just hanging out in this area is fine. But if in the next 2 days, S&P breaks that low and goes down even further, the place to watch, I'm just giving you this whole spiel, but like the place to actually look is credit spreads and banks, spreads and banks. Because that's the pipe. You can actually see the pipe.
Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions. You're going to be hearing all about them later in the show, but for now, Mantra, thanks for making this episode possible.
Welcome back to another episode of On the Margin, and joining me today is Alexander Campbell, founder and CEO of Rose AI, and who has a long storied career. He's worked at Lehman Brothers. He's worked as head of commodities at Bridgewater Associates. He's been the founder and CIO of his own global macro hedge fund. Has worn a lot of different hats over his career, and it's going to be really great to tap all of those. How's it going, Alex?
Good. Thanks for having me.
I've been reading your Substack recently, and you've had some really interesting, education and explanations of what's been going on in the markets. It's been a big week, to say the least. We've seen the VIX print one of its highest prints ever, and there's been a lot of very, market structure driven moves over the past week. So, back in June, I saw you had a post come out where you started to really explain this dispersion trade that's been going on, this really, narrow rally that we've been seeing in these AI type companies like NVIDIA, and what that's been doing to market structure. I'd love if you could just paint a bit of a picture starting from there to basically what's happened this week and how that's all been somewhat related, and just try to explain to listeners what's been actually going on from somebody who's, been in the weeds of traditional finance.
Yeah, for sure. I'll give you my interpretation. I'm not, running active money in these markets in a big way right now, but I'm an observer and a lover of these markets and kind of, the stories they tell. I think when you see market moves of the kind of velocity, magnitude, viciousness of the last couple of days, you generally, when you see that out of touch with the economic reality or the shift in expectations around economics, you generally want to look for a market structure explanation, especially when it comes to volatility regimes, credit, vol, that kind of stuff. So, the piece that I wrote in June was an attempt to kind of look at what was happening then in particular the big markets in the world, the US S&P, the kind of tech bubble, that kind of vibe, and try to understand how when you have these gigantic tech companies making up such a big part of the index, what does that do to the realized volatility of the market, how much it moves around? How does that get discounted in things like correlation, where there are traders who have to make bets between how the market's doing versus the individual components? And then the knock-on effects that kind of behavior has with market participants who are generally looking to make short-term investments and take advantage of things like the gap between implied volatility and realized. And there's a bunch of terms in there that I'll kind of try to unpack here as we have this conversation that are a little technical. But the long story short is that there's this weird dynamic with volatility markets in general, that if you're betting on volatility to go down, you want to short volatility. What you end up doing is take positions in underlying options that are essentially short volatility, short optionality. What that means is that the exchange that you get for taking that position, for selling options, roughly speaking, is an insurance premium. And the insurance premium is paid because the activity of trying to hedge the actual realized moves of the market up and down force you to do whatever the market is doing and to exacerbate that market, which is a really confusing thing. But it means that when the market's down 2%, somebody who's short vol gets more and more and more exposure as the market goes down, which means, in a long sense, as the market goes down, they have to sell more. They have to sell more and more and more in a convex way. Same thing when the market goes up. When the market goes up, we're now under-hedged or over-hedged, depending on your perspective, and you need to buy shares. So what happens to a market when it's ripping and people need to buy shares? It goes up from 2 to 4% really quick. And this is mechanical. This has to do with risk and a position in their book, which is kind of indifferent from the actual underlying direction of stocks. And that's why you see moves going up as fast as they go down. It's a function of all these people having sold options and having to hedge those options in the market. To go back to the dispersion trade in June, the reason why we wrote that the market looked to be, vulnerable to this type of move had to do with, NVIDIA, Microsoft, Apple, et cetera, just becoming the whole index. Because when you have a scenario where one or two stocks in a market cap index are such a big percentage of the market, they dominate the market, right? NVIDIA goes up, the market goes up. Why? It's 40% of the index. Makes sense, right? Same thing on the way down. You have this blob of tech stocks that are kind of moving up and down together, very highly correlated, but not that correlated to Exxon or, agricultural stocks or whatever the heck else is in the S&P. The reason this all matters, okay, and I'll try to tie this out, is that this is a mechanism for contagion, meaning when there's volatility in those main stocks, those main tech blob, and they all go down at the same time because of the unwind of a carry trade or because people get spooked about AI or whatever it is, the folks that have sold equity options at the index level, at the S&P level, mechanically have to swing around everything else on the basis of what happens with NVIDIA, Microsoft, et cetera. And so this is this notion of contagion through funding, contagion through associated trades, contagion through correlation that you got to watch out for. Because as we're seeing in Japan, you can get down 20%, down 10% days on nothing more than these market mechanics having to do with who sold what kind of position and how they're positioned in the short term to do things like carry trades or short vol trades.
Awesome. So who are the people putting on, honing in specific on the dispersion trade right now? Who are these types of people putting on these trades? We hear a lot of the time whenever something big happens that, a pod shop is blowing up or like these multi-strat funds. Are these the players? And if so, what exactly does that mean for people that aren't in the weeds of that world? And, why are they focusing on, like market neutral type of trades like that?
Yeah, you can think about it as an outgrowth of the market making business that most major broker dealers have, because you have people who trade single stocks and you have people who trade index, and they're not always the same person, right? They have their own books, they have their own buyers and sellers, they have their own risk process. But imagine you're, Lehman Brothers or whatever, it's 2006, and you got a guy who's got a big basket of individual stocks, options on those stocks in particular, volatility speaking, and then somebody else who's trading options on S&P or SPX or even ETFs associated with that. Well, now you have a firm level issue because these are not two disassociated markets. They're like a connected market, right? They're the same market. If you add up all the individual stocks, you get the index. So what ends up happening is that this risk is not naturally born. Correlation risk is usually a hard risk for banks to manage because it's about this desk versus that desk. And what used to happen pre-Volcker rule, Dodd-Frank, that kind of stuff, is that there was a group at the bank that kind of looked at these markets and would take a position in proprietary trading on the back of that. They would make a dispersion trade one way or the other. They would make a bet on correlation, and that would kind of add liquidity to both sides of this market and then help the flow people trade their market. Now, Volcker killed that, basically. And so what ended up happening is that you get some of this behavior kind of buried within the individual desks, and they're pretending that it's flow trading, even though it's really, hedging their risk. But a lot of it moved off bank balance sheet. That was kind of the goal of Dodd-Frank. And it went into, hedge funds, private equity in some cases, like private credit does a lot of this stuff, not dispersion, but they pick up a lot of the things that used to get done by prop. And that's part of why you see this explosion of pod shops. It's not just that, it's the best way to manage money. It's that a lot of that economic behavior actually had to move outside of the bank. And I think Citadel Securities is kind of a good example of this, where you have Citadel who makes like real prop bets. They're in the market trying to predict direction, that kind of stuff. And then Citadel Securities market making, right? They're using that acumen about financial services and about hedge funds to be able to provide liquidity in this kind of way. And then it starts to look a little bit more like prop. So the reality is there's a huge spectrum of risk taking. And, regulators say some of it has to go here, some of it has to go there. What's interesting as a market participant and someone kind of speculating in the markets is that means that there's naturally alpha in these places because it's broken, it's disaggregated, people aren't looking at the relationship between credit and equity vol or any of this other stuff. And that behavior is the behavior that naturally kind of should occur under prop groups, prop shops, prop pods is another way of describing it. So when you hear about these big pod shops, you have a lot of individual businesses that are kind of running at that risk and looking across markets. Another classic example is the Treasuries on the run, off the run trade. This is the trade that kind of blew up LTCM by some measures, along with equity vol. Surprise, surprise. But this idea of like, look, you're buying a Treasury that matures in October, you're buying a Treasury that matures in November. They're basically the same thing, especially when it's 10 years away. why should what the government auctions are doing affect that market? It doesn't actually affect that. Well, it affects that market insofar as the demand and supply and the funding is dependent on that tiny little spread. And when the spread gaps out, they lose money and their counterparties come ask them for cash. So it's the same story over and over again. Same thing with carry trade, right? All these trades kind of end up looking like a short vol trade. And then you can get into these existential arguments about is long beta, long levered beta, a short vol trade, maybe, but that's like a longer, conversation for some PhD.
Yeah. So, I mean, overall, what's been occurring, if we just look back at, okay, late June, you were mentioning about this dispersion trade. A lot of these pod shops were piling in pretty deep on it, whether it's, the dispersion between index and single stocks, or even if it's possibly, long the Qs and short IWM or something like that. And then also, traditional components like the treasury carry trade of based on this author on treasury securities as well. So these were all getting piled in. And, early July, a lot of folks are starting to look at something like the 3-month implied correlations index. And we got down to historic lows, like around a 7. And there's a lot of concern around that. So that started to happen in early July. And then it felt like it was a little quiet. We saw this, the big trigger was the CPI print that happened around that time. And that seemed to have shifted markets a bit. Suddenly small caps started to run and Q started to come down. So what was going on there?
Well, I mean, it's always hard to tell how much is real money versus a meme versus people trading, inflation and growth and that kind of stuff. I think we saw a couple things, happen at the same time. One is we're at that point with AI where there's tons of infra build and no monetization outside of people selling chips or servers. It's just, there's a million startups. I'm a startup in the space. Everyone's polluted. No one's making revenue yet, at the $100 million range or whatever. And there's this kind of well, when will the cash flows come? So that's been kind of, you have to have baked that in since ChatGPT in last year, just because it got so overheated that there's clearly going to be some sort of set off. The other thing I like to talk a lot about is there's bonds in the stocks, right? We had a ton of tightening, and by and large, stocks just ripped right through the tightening, meaning that the implied earnings growth was pretty high relative to the discounted rates at which those earnings are going to get, present valued. And then there was this thing about, okay, wait a second, maybe, we are past the inflationary part. Maybe we are at the precipice of a recession. We've been in this kind of weird state where a lot of the surveys looked bad a year and a half ago coming out of the post-COVID boom, and they looked very recessionary. And that it makes sense that housing would be weak. It makes sense that big purchases, big investments would be weak because interest rates are high. So there's a little bit of I think vulnerability in the market in terms of why this is cascading now, right? I mean, there was a CPI thing, then there was the BOJ raising 50 bips. Then there was a moderately bad unemployment report and it triggered the SOM, thing. But this is kind of the classic short vol kind of market behavior where you have these little moves that don't seem like a huge deal. And the thing that actually hits the market is not that move. It's the impact of that move on some levered player who's, running some book that's not ready for, high yield versus investment grade to spread in a certain way or whatever. And that, triggers a deleveraging among that desk, that book, that player, that bank, that fund, whatever it is. And, all financial crises kind of look the same in the sense of you get tightening. And then someone who's out on the risk curve, who's not doing something totally bonkers, but is a little bit over their skis, they blow up. And then that causes this kind of cascading set of deleveraging effects where if it gets too out of hand, then the Fed comes in and, not only lowers rates, but buys stuff. So, we kind of got confirmation that the Fed was easing. And so that kind of let everyone go, whoa, maybe there is a recession. And then I think the Japan thing just kind of went ape. I think they did have too much carry trade. I think the yen started rallying. They had to puke stocks. I mean, their banks were down 25% in 2 days. So that's clearly something kind of mechanical. It's not just about interest rates and that kind of stuff.
Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions into Web3. So you guys have heard me talk about Larry Fink talking about tokenization. You've seen the clips on CNBC. You know that Larry and BlackRock are very, very excited about this idea. And the reason for that is they're looking at these trillions of dollars of off-chain real-world assets. They want to digitize those and bring them on-chain, which is going to be a massive opportunity. But in order to do that, they need a compliant L1, and that's where Mantra comes in. Mantra's been steadily climbing the ranks and now stands among the top 4 RWA projects on CoinGecko. which is representative of its rapid growth and influence in the tokenization space. Mantra is built using the Cosmos SDK, so they have some very cool stuff out of the box. They've got IBC interoperability. They also leverage CosmWasm smart contracts. Very cool design from an architectural standpoint. The next phase on the blockchain's testnet is Hongbai, so that's launching soon. So if you're a dApp developer or something like that, there's a lot of very cool opportunities for you, and I highly recommend that you click the link at the bottom of the show notes. That'll know that I sent you. Thanks very much again, Mantra, for making this possible. And again, guys, click the link at the bottom of the show notes.
Could you explain, you mentioned a couple points there, but overall, this idea of the carry trade, people are trying to figure out, is what has affected markets so significantly or not? So could you just explain what is that yen carry trade and where does it stand now, do you think?
Yeah, I like the word carry trade because it's supposed to be very evocative. It's like, imagine you're living in a world where you don't trade electronically, you trade with like donkeys and like bars of silver, right? So you take your silver, you go over to the next town, right? You buy some stuff, you bring it back, and you sell it at a higher price than you could have bought it in that town, right? So you could think of this as, we like to look at really old commodities data. You go look at like Parisian wheat prices from the 1830s, and you're looking at them against like Berlin or whatever, and you can kind of see the ripples of global capital, but through the wheat markets or whatever. And it's basically the same thing, just with money. So, imagine you're an investor in Japan and interest rates are zero, and they've been zero basically forever. You might want to get some return. So the way you get that return is you borrow at zero and you go buy stuff. You go buy stuff abroad. And most of the stuff abroad has a higher interest rate. So you're getting a nice little relationship here where you're borrowing at zero and you're lending at 2 or 4 or 6 or whatever it is. That's what banks do, right? Banks borrow short at low rates and they lend long at higher rates. So they're kind of engaging in some financial transaction. The problem is that they are generally hopping outside of Japan to do so, right? They are selling those yen and buying dollars and then buying a treasury bond or a US stock or something like that. And so that means that depending on how that transaction was structured, if the interest rate that they're borrowing at goes up, right, you get this weird unwind dynamic where someone goes, wait a sec, I was making 4% a year on this trade levered 20 times or whatever. But now that the interest rate's a little bit higher, I don't make as much money. So I want to do less of it, right? Well, in doing less of it, they're selling that US Treasury or that US stock and they're bringing the money home. Well, when they bring the money home, they need to buy yen. That pushes up the yen. That then means that people who have shorted yen, borrowed yen to do this trade, are now kind of off foot because they had to pay back, yen at 100 or whatever, and now it's 20% higher. They owe 20% more yen. So that kind of 4% clip of carry gets eaten up really fast when the spot prices move, which is what happened. Now, there's no reason for this to mechanically lead to like the Nikkei exploding, right? It's more that because there's levered players who are sensitive to funding conditions and they're getting, their capital called, or they have an associated trade in their portfolio or someone else's portfolio in a financial institution and they're blowing up, their boss comes and says, hey, you got to take some risk off. And stocks are risk and, foreign assets are risk. So they get sold. So the jump between, hey, carry trade's blowing up, like why is the rest of the world moving around, is a little bit of a weird, thing to think about, but it's not that different from like CDOs blowing up in 2007 and that, imperil Citigroup or whatever, because they just had a bunch of CDOs and they took a bunch of losses there.
That all makes sense to me. And it feels like now we're getting to this point of people trying to figure out, is this an economic thing or is it over leveraged traders are getting caught out because of, perhaps marginal, weakening in the economy, making these trades harder. So how do you discern between, I've seen you describe it as being, the volatility machine is breaking, not necessarily the economy. So what does that mean between those two? And when does it happen that, these big, it seems like when you look at like a chart of history of like, big VIX moves or something, it's like this weird thing that happens first in markets and then something like a recession follows later, like the economic fundamentals come after. How does that work?
There's a part of it which is endogenous, meaning in the system, and a part of it which is kind of exogenous, meaning like it doesn't really matter, or I'm saying as if it does. But you can think about that being a tripwire in the sense of if you get enough leverage in the system, and what is enough leverage is kind of an existential question. But if you get enough leverage in the system, that loss on that carry trade could bankrupt your financial institution, right? It's not just a loss. Now it's like, oh my God, we got to sell everything. And now you're selling mortgages and corporate bonds and anything else you have, just selling. And it's clear that there's some of that happening, but probably not enough to really blow the whole machine up or whatever. But that's kind of what's so interesting, I think, about financial crises. It's like you go back and you look at like the Knickerbocker Trust of 1907, or like 1873 or like 1838 or whatever. And it's like Andrew Jackson gangs up on the central bank at the time and says, no more central bank. And then the Bank of the US .2 or whatever goes away, and someone has a deleveraging and there's no buyer of last resort, and then all the banks blow up. And it's like, it's always kind of the same in that sense. Same with Knickerbocker Trust. Knickerbocker Trust goes under, all these big, massive banks are going under. JP Morgan takes all the bankers, locks them in his library overnight, and he makes them write down how much they're going to put in to bail them out. I've seen the piece of paper. You can actually look at it in the library. And like, it's always the same, right? And so the Fed is like this special position, but it's not that special in the sense of it's just doing a role that, rich people could do if they had enough money and were public minded or whatever, and like motivated, incentivized. But it's that, okay, you have this like thing flashing red. Does it bleed into the credit system? Does it get into the broader markets? Like, does it start impacting the credit provision for mortgages or corporate investment and that kind of stuff? And right now, there's no evidence that it is, right? But we know we're at the end of a cycle. We know there's been a lot of hiking. We know that U.S. housing has been incredibly strong, even with a gigantic amount of tightening. And how much of that is, labor and immigration flows and that kind of stuff, I don't know. But it feels like there are people that could be, negatively hurt by this. The place to watch, I'm just giving you this whole spiel, but like the place to actually look is credit spreads and banks, because that's the pipe. You can actually see the pipe. So you look at, CDX has an investment grade spread, a high yield spread. Europe has this thing called the crossover. And, if high yield spreads are 700 basis points, that just tells you, hey, it's in the real economy. Right now they're at 300. Right now investment grade's at 60 basis points. If that goes to 200 basis points, if Ford can't refinance its debt, that's a big deal. So we are at the point where it hasn't yet done that. And it looks like vol blow up, local problem. We're going to engage in some easing. Maybe it's still soft landing. I don't have a lot of strong view. My recommendation or view is like, you short the credit, you sell the equity vol because it looks like this little bubble that is going to fluff out. And then if the economy really does crap out, the credit will pay out, right? But the credit probably won't pay out, and then you make money on being short vol. But I wouldn't, if you have a very long levered book, I wouldn't go out and short vol right now, because you're just putting yourself doubling down on something that the move is kind of already over, and you're not going to get that much juice out of it.
Yeah, credit spreads has been something I've been pretty closely watching too, to try to figure out whether this move has momentum towards it. And, I was looking at more so the ETFs of like HYG or LQD and looking at how those are interacting. But what you're mentioning too is just looking at the direct spreads of like high yield and investment grade, which for those that are not, in the weeds on credit, credit spreads themselves are basically the risk premium on corporate bonds that, pay for a possibility of default, and what are those odds? So high yield has a higher probability of default, so higher spread. As recessions occur, the probability goes up, so then those spreads widen, and they'll generally widen more for high yield because it's riskier debt versus corporate debt. So looking at that, so far what we're seeing is that there's been some uptake, and if you just look at say high yield, the IG spread, that's been increasing, but it's still in relative manageable levels, right?
Yeah, it's not. It went up not as much as you would think, and definitely not at the rate at which you were really worried. And most bank stocks outside of Japan look pretty fine. So I would look at KRE regional banks. That's the real economic weakness problem, which is the corporate CRE lending. If we get a housing problem, the little banks will get hit too. So that's my bellwether. I'm not like super bearish on them. I just think, were we to get a recession from the tightening and the losses on balance sheet, that's where it would hit.
So, that's all occurred. We just sort of painted a picture over the last couple of months of how we got to this point. And now we're seeing this, vol has come down, but, there's still a lot of variance in the moves of equities these days. We're seeing like the Q is up 3%, and then, after hours, they dump another 1%. You've been talking a lot about how the market is short vol. What does that mean? And how does that, square up with, I imagine if the whole market was short vol and vol exploded like we've seen, there's probably some dead body somewhere around that. But overall, like, what does it mean that the market is now short vol, and why is that making these moves so wild?
Yeah, every option transaction, there's a buyer and a seller. So when you say, oh, short vol, you're making a claim that is a little hard to verify. When I sell you optionality, right, the net impact on the market of the hedging flows depends on which one of us is hedging. Meaning, let's take a call option, right? You think let's say Google's $100 a share. you want to buy a $105 Google call option. That means you think it's going to go up a bunch, right? And if it goes to 120, you'll make 15. You're probably not going to hedge the delta. You're not going to hedge your exposure as the price goes up for your call. You're just going to be like, hey, great, I want that kind of upside. I want that change in my exposure. I want that convexity, basically. The person who sold you that option doesn't really want that, right? It's like selling a credit spread. It's like you have unlimited kind of downside. Same thing with a put, although you have limited, but like there's a lot of downside. And so what the person who sold you the option does generally is they'll hedge, meaning if they sold a call option, this gets a little technical, but they sold you the call option, as the price goes up, they have to buy more Google because that option they sold you used to be out of the money, meaning it wasn't really a real thing. It didn't have a direct connection to a stock. But imagine you sold the call option at 100 and the share price is 900. Happens all the time, right? Well, you basically have that stock, right? You're basically that stock. Like you have an $800 in the money thing. The strike is 100. Like really, you own that stock. That's what we call 100% delta, or deeply in the money. As those options go from out of the money to in the money, the person on the other side owes you the stock. They owe you the stock that they sold that option on. They need to go buy it, right? And if they sold you 1 million shares, they need to go buy, some proportion of that million to kind of make up for that exposure, because they're not in the business of taking directional risk on, Google, Ford, anything. They're just in the business of trading options for option's sake, volatility for volatility's sake. So what ends up happening is a lot of people go out and buy puts and calls, and they're like, hey, retail, hey, I want a 0-day put and call. And then the bank or the flow provider, which tends to be the pod or whatever, the ultimate risk holder, is hedging the market against it. Okay, long story short, right? That means that, again, the more the market goes up, they have to buy. The more the market goes down, they have to sell. And that happens when you're asleep, right? When the Nikkei is moving and the S&P is going down, they're going to have to hedge. And when they decide those hedging trades pushes the market further one way or the other. So the thing we could have had happen in the last couple of weeks, I don't know, right, is a bunch of people kind of programmatically, just more systematically, were capturing risk premiums by selling optionality, selling vol, going long credit, this stuff that I keep talking about. And then this big spike happened. VIX goes to 60 on paper, who knows what the futures really were at, 40, 30. And a bunch of people go and sell into that because they have, they're excited to kind of get that new opportunity. That means you have new people in the market doing this, which means maybe more people in the market doing it, which means maybe we're actually short vol. Now, that doesn't mean they're not going to make money on their implied volatility going down. They probably still will make money on that if they made a good sale. It just means that the market will move more up and down than you would normally expect for really stupid reasons and small moves. Mm-hmm. Because, hey, it's up 50 bips, I got to buy some. Hey, it's up 2%, I really got to buy some. And so, you get stuff like today, the unemployment report, initial claims was like 7K below what they thought it would be. Yeah. And like the market's up 2%.
Pretty close to noise, in my opinion. Like that is such a small.
That's short vol. That's classic short vol behavior, right? And it's this thing where you could spend like 4 years, and people at, these funds do, crawling through all the reports and trying to stitch together, where the short vol is and the long vol. And mostly it's useless because like, unless you're really on top of this stuff, like it's not going to be that useful. But at the level we're at, when the market starts moving around and you're reading about Nikkei being down 8 and then up 6 and then, what the hell's going on over there, that's just short vol. It's not necessarily saying the economy's blowing up. If like Bank of America was like, oh my God, we got to raise capital and we're not paying a dividend and their stock was falling 40%, that's when you're like, holy moly, this is real volatility. You know what I mean? Big corporates that you've heard of, things that are mattering, right? We just had a huge market run up, and getting a little off the top is not that bad.
Yeah, it's not bad at all. So for that healing process to occur, for vol to kind of dampen down a bit, is it just time, or what happens?
Some of it rolls off mechanically, right? So during COVID, I don't want to name names or whatever, but there were some big hedges in the market that we had a huge vol in April because that was the strike price, meaning that was the most sensitive short volatility period. So you saw up 7, down 7, up 7, down 7 breakers all over the place, even on the way up, right? So some of that will just work its way out over time. Some of it, when it starts to go like and get bigger and bigger, I don't know if you can see which side I'm on here, but that's where you're like, okay, the short vol is actually triggering people who are levered beta who have to now capitulate. When you see credit moving, when you see bonds moving around really weirdly like they did in 2020, when you see disassociated assets just getting trashed, you know what I mean? Someone reports bad and it's down 40% or something like that. We saw that a lot in 2020. That's when you start to go, wait a sec, this isn't just a mechanical thing. Like, yeah, we're a little short vol, but we're also short like risk. Everyone is
Yeah.
like basically short macro volatility, not just like equity, stock volatility.
Mhm. Yeah, nice. That's a great explanation. So, to put that all together, we had some, significant market structure events that were potentially triggered from some economic fundamentals, but the momentum into how it broadens out into things like credit spread is not there yet. So we just have to sort of, wait it out and see what happens next, right?
Yeah, next couple of days, like you really don't want to see us go through the lows. That's the big thing. So I was like a little freaked out last night because we started going back down. And like you really want to see just hanging out in this area is fine. But if in the next 2 days, S&P breaks that low and goes down even further, now you get this other two-headed monster of lower lows, which forces people to sell, and the mechanical process by which realized volatility, aka the up down up down up down, forces systematic investors to sell because they need to de-risk. Meaning, if stocks are actually moving 40% a day all of a sudden, it's prudent for anyone who runs a quantitative or systematic portfolio to be like, I don't want as much risk. Like that's too much. Like it's moving around too much. Chill out. And like these guys have to estimate how volatile the world is, and they use
Because
things like
their VAR is based on it too, right?
exactly. And even the regulators go around and say, you take risk like this, you take risk like this. If it moves around too much, you got to sell. So we want to see this get out of the market fast, like next month. If it's still hanging around in October during the election, like it's a little bit gnarly.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back Permissionless. We're going to be doing Permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
Well, let's take off our quant systematic macro fund hats. And in the second half of the show, I'd love for you to talk a bit about your current hat. You've been going pretty deep on the AI world. You started your own startup, Rose AI, which I think is really interesting. So, maybe starting a bit with just your high level thesis of AI in terms of its relevance for either, finance, macroeconomic analysis, and how does Rose play into that thesis? And what are you actually trying to focus on? And what are the signals versus just the AI noise of, ChatGPT taking over the last year and a half or so?
For sure. Yeah. I mean, I think it's probably one of the most interesting questions. I kind of play both sides to it because I'm on the internet trying to fight these doomers who think that, the robots are going to eat the world. And meanwhile, it takes us 20 minutes to get my Bluetooth working before this call. So, I think we have to kind of appreciate the power of technology and also its failings. And I think as a practitioner, like I've seen that a lot. And so my kind of turn to this space happened kind of organically. I was kind of a quant systematic investor at, Lehman, at Bridgewater. And at both those places, like my job was basically data aggregation in a weird way, like finding all these different things that were out of whack and then trying to, optimize on top of it. The equity versus credit is a good example. That was like a system that we ran at Lehman Brothers where you would literally look at equity and credit and trade across the two. And part of the pain was just getting the right data feeds and then knowing how to line up the data and knowing, how to like look at that thing. Bridgewater, I can't talk too much about, but they do it in a macro context, right? It's like you want to look at the world and understand growth and inflation and then what assets trade on the basis of that. And, they are, I think, the best in the world at that process of building a systematic understanding. So, flashback almost now 10 years, I'm, doing commodities at Bridgewater and I'm really a data guy. Like I'm a markets person. I've climbed the pole to this like halcyon place. Like it's kind of like the Olympus for macro folks. And I'm just like, holy cow, like we're doing this data thing. And that happened. And then I started, just from being a kind of systematic person and being into CS a little bit, started experimenting with AI and I came upon like word to vec and that kind of stuff. And even stuff like R and pandas, this is like pre-Snowflake. And I was just like, you know what? AI is going to make this whole stupid thing easy. Like the killing yourself with the pip install 500 packages and the environment manager and the IDE and the pushing to GitHub and the like, holy cow, I look at the best investors I know and they're all still in Excel. And
Yeah.
they build huge engineering organizations to aggregate, filter, and clean data from all these different sources. Enormous amounts of money doing this, and I'm like,
Am I right in thinking that a lot of the alpha these days for these funds is found from finding these like basically off market data points and triangulating them with like on market data, right? Is that where a lot of the alphas derive these days?
it's kind of both. Yeah, on market is kind of a false distinction because it's a spectrum, right? Like if you're a credit trader, you might really know that data really well, and then the guy who trades treasuries like doesn't know it at all, and that's alpha to him or whatever, right?
Yeah.
But it's true that every good investor I know spends a lot of money finding, cleaning, managing data about their investments, right? Whether it's stocks, whether it's spreads, whether it's currency futures, whatever the heck it is, you got to have market pricing. You got to have, what's driving that market pricing, and then anything else you can find. And that's basically finance, right? Finance is just assimilating and aggregating and kind of churning information. And the joke is like, you get the Sunday scaries because your whole life is like making a chart for some PowerPoint that someone never reads or whatever. And you're like, what am I doing with my life, right? That kind of thing. I mean, I've had that a million times. And I think that the other kind of meta narrative, not to be too rambly, that I encountered was this real lack of empathy from California tech people about what was going on in finance and the pain and the burnout and the incredible late nights of just grinding to get to deadlines. Where in California, it's very California. It's like, it's kind of due tomorrow. How many users do you have? About 1 million. What's your revenue? 24 million if you don't count the stock-based comp or whatever. That's not how it works in New York, right? In New York, it's like, did you mess with the data? You know what I mean? Like stuff, like the SEC shows up at your door, like real, like, intense things, not just with the government, counterparties, trading, and I think people who go through that kind of classic financial training experience it. We know it, we talk about it, but we don't share it that much, like how much hazing and all that stuff that goes on. And I saw that as a gap. Okay. This gap of like every startup I've seen, including most of these AI startups, are trying to kill spreadsheets, basically, in a weird way. Meanwhile, like the Medicis were running around with double entry bookkeeping on spreadsheets. Like I've seen the founding documents of JP Morgan. Again, you can go ask them in the library, and it's a big ledger. And it's like on page 2, like Mr. So-and-so takes a stock on account, and he's just gambling the money from JP Morgan. You know what I mean? This is like 100, 200 years ago stuff. But like, that's what a bank is. It's just a big record, right? Same as crypto, same as like blockchain. It's just a ledger. It's just a ledger that we all agree on. That's what payments are. That's what the financial system is. And so I was very fascinated by the role that the financial system was playing, and then the just abandonment of technology of this problem, right? Mm-hmm. And so our approach to using AI, right, to this problem is not build the smartest robot in the world, because OpenAI will do that tomorrow, Claude will do that tomorrow, Google will figure it out. There's a million big companies with servers. What we try to focus on is the pipes, the pain, the warehouse, basically, that holds that centralized version of truth that every financial institution is working on, right? And it can be in spreadsheets, it can be in Jupyter notebooks, it can be in SQL databases, or it can be in Snowflake, it doesn't matter, right? But there's this huge unlock, last kind of step to this, which is this crazy weird regulation in Europe called MiFID II. And MiFID II says that investment banks can no longer give away data for free, which is really freaking important. They can no longer give you shit for free. Okay. And if you're, an institutional investor, you get a lot of shit for free, right? You get a lot of really great data, you get a lot of great research, all this stuff. And so you have this real, I think, interesting shift in the mentality among financial institutions. You see this among big asset managers as well, where they realize that their LPs, their investors, their counterparties are actually depending on them for a lot of the information that lets their machine run. And that's what we want to kind of incentivize and monetize. We don't want to do SaaS. I think SaaS is the wrong business model for finance. If you get the MD to look at your stupid chart, like don't charge him $25,000. Just be happy that he's using your stupid, chart or whatever. And that's how we're going to change finance. We're going to use AI to automate the crappy parts. We're going to use AI to automate discovery. We're going to use AI to automate the interaction points between the analyst who's super smart at that domain, right? Maybe they trade rice and whatever nation or whatever, or, like pork futures, and connect them to this huge world of data that just exploded on them, right? Yeah. Where it's not just big data vendors. It's not just alt data vendors. It's startups that are selling their data exhaust. It's other traders that have little models that they're willing to sell. It's really like a creator economy of alpha of information. That's what we're trying to build. So it's a big build, but it's fun.
Yeah, that's super cool. So, I imagine there's a lot of startups out there right now too, looking at like, how do we revolutionize these parts of finance? And, taking a big picture view of being somebody, sitting in that seat of trying to reinvent this, like, where do you see the finance industry going? Like, do you still, see a ton of jobs for investment bankers, for fund managers? Do you think we see markets get increasingly efficient to the point that we should all just, lever long beta and call it a day because there's AI, systematic funds just squeezing out every bit of alpha? What do you think?
Oh, well, I don't think the human ever leaves the machine. This is my principal beef with the doomers. This Yud crew or whatever, where they think that like the robots get so smart and so capable and so misaligned that they wake up one day and they're like, "What's up with these humans? Let's just kill the humans." Like I think that fundamentally misunderstands the relationship between humans and machines. And it's evident that I love these guys because I go and give talks there and stuff, but that it's a bunch of Berkeley gigawatt geniuses who've never actually coded or traded in their life, because the moment you use data in investment or quant, you realize the machines break all the time. And 90% of your pain in your life is making these stupid machines run and run every day and run reliably, because again, you're in finance, and in finance you're held accountable. You got to be transparent. Someone's going to ask you for your documents or where the data came from or all this stuff. And so that's where the long nights come from. That's where this pain comes from. And we socialize it to people in finance classically, or even consulting, in like the million edits to your pitch deck. You
Yeah.
had the
Yeah.
experience where
You go and study science or something, and then you just end up in PowerPoint moving like a logo
yeah,
or something.
and someone dumps a thing on your desk and it's red marked and you're right. But there's an actual real critical cultural norm that's being inculcated there, which is like, I tell you how this contract looks and you do it. And if you don't do it, you tell me immediately, because it's going to go to someone who, has a home building business that has $10 billion revenue a year. And like, I'm not going to look at it because I'm on the beach in Ibiza or whatever. Like, this is like the MD investment banker vibe. But it's that real sense of like, the truth is what you got from the outside world and your judgment. And you have to be willing to disassemble all those two things and have a conversation about it. And I think that never leaves the financial system. I actually think that we've supercharged that. I think that if you look at what AI is bad at, hallucinations, like big lists of stuff, manipulating data, it's really great at making code, but it's really bad at managing data. That's where the financial system actually is complementary to kind of the tech world, or what I call California. So I think California and New York, there's this kind of culture clash, but that's a big opportunity, because the California folks don't even really understand what all these people are doing in spreadsheets and why these PowerPoints matter and how the business works. And I think you never leave that. So in terms of then your kind of hidden question about like, should I just go long levered beta? Sneaky question there. I'm not the person who thinks we're going to have a hyper takeoff. I think, I'm an options trader, so the idea of the singularity, just always having a first derivative which is flat, is totally fine with me. You know what I mean? It's like either it's fast or it's slow, but it's first derivative. When you look at it every day, it's it's a straight line. And I think you always have humans in that machine. And so, I would look for revenue from AI companies that are not just Microsoft, Amazon, Apple, that kind of thing. That's your kind of real takeoff, I think, moment. I don't think we're there. I think, probably we get some sort of middle muck through recession. Probably we get some more drawdown in stocks. Then I think there's a huge potential generational buying opportunity if we get a real drawdown and the Fed, cuts enough. Because I would love some ZERP again, wouldn't you? I mean, that was so much fun.
Yeah, it was fun. Obviously, we've seen Nvidia come down a decent chunk here, and it feels like when I look at what's been going on in the AI world, I haven't traded it that much or anything, but it feels like a lot of excitement got priced in pretty quickly at the same time that a lot of capex investment was being put into these companies. And those capital investments take time to pay off. Like they're going for the long game. And you see some of these companies like Meta invested pretty significantly in that capex expansion, and their stock got hit because these analysts want to just see a juicy EPS every quarter.
Yep.
They're not really paying attention that much to the medium to long term game. So with that in mind, how do you see like the next 4 to 5 years? Is it just a cool off as that capex build occurs, and then we see this next wave of adoption and innovation, or what do you think?
I think it's interesting the way that the incumbents have related to this technological shift because they are way more long it than usual, right? Normally, what happens is, think about like IBM getting kind of, put to the side by Apple and Windows back in the 80s or whatever. It's like they have this kind of dominant paradigm, this new paradigm comes up, and then they just ignore it, and then it just runs away with the world, right? So, you kind of had, it was interesting, Zuck make that first jump into VR because he thought that was the platform. And then, amazingly saved by the fact that he was buying the same stuff he needed for the AI. GPUs, right? He's even said this in tape. He's like, we got lucked out. So he had all this compute he could just throw at it, and that's why Llama exists, which is wonderful. But the interesting thing is, what are these companies doing? Well, they buy a bunch of capex to make all these servers, and then what happens to the servers? Well, they use some of the servers, but they actually also rent it out. And the really interesting thing is, who do they rent it out to? They rent it out to startups that they invest in. Sounds like a good deal, right? I buy some servers, I get a bunch of startup equity. Why not, right? So I think that's good in a way. It's also kind of monopolistic, and it's like part of the centralization of power that I think AI kind of has. But I think you'll see enough kind of interoperability with the smaller firms and the big firms. Otherwise, why am I even starting this company, right? Because OpenAI will do it in 5 minutes. Like, I think that a lot of companies will become providers of data or consumers of data from central LLM type, repository tool products things. And that's actually a huge growth spurt. And when people talk about singularity, they talk about 10% growth, which is nuts. You would have to have that, right? Because you need revenue for 10% growth.
You mentioned, centralization of power. And the first thing that, piques my mind is a lot of, what we talk about at Blockworks, which is the crypto thesis of decentralization. There's a lot of different avenues you could take your crypto thesis. I don't know your personal one, but you could either, when I look at something like Solana, where it's all about like instant finality and settlement, which is a great innovation for finance, or you could look at, there's been some talk of, decentralized AI through crypto or blockchain rails. What's your perspective on that whole world?
Yeah, I'm not the best person to ask because one of my best friends from Stanford asked me about Coinbase back in like 2012. And like I tried to use it and they like DQ'd my trade. And I was like, oh, they're running a brokerage. And I felt so smart about myself. And like I was the biggest freaking idiot ever because now it's, I literally could have given like a check and been a millionaire. So know who you're talking to here, okay, in terms of like my bias. But my framework then, now, in the future is that there's this weird thing about money where money can be, kind of cool or it can be boring. And the moment it's cool, it's no longer money because it's confusing and scary. And so when you apply that to crypto or Bitcoin, it's like Bitcoin or crypto can be cool or it can be money. It cannot be both. And the implications of that are tons of technological innovation in the back end, and the front end, you're going to have banks. Like, I'm sorry to tell you, but end of the day, you're going to have banks. Coinbase is a bank, you know what I mean? And that was my stupidity. It's just like, no, you need interfaces for this technology, even if it can do all this cool stuff where, you have money on a chip and who cares about the government or whatever. And then you notice that in order to use those tools, in order to become boring, the banks then have to negotiate with the US government or whatever. And so there's this weird churning in the crypto world, which I'm not a native person, where it's like kind of some of the best parts of crypto are parts that make it hard to make it money, but we need something that does it. And I think eventually they'll figure out pipes that kind of clear it. Just like we had gold back, 200 years ago was the reserve. Why not Bitcoin? Makes total sense eventually, especially if you don't want a dollar-based economy. In terms of can we do AI on crypto? I think no, just pretty clearly no. It's just too compute intensive. And, we can't even process enough transactions to do a payment system. So how could we do 4 AIs all trying to answer your question and giving you different answers? And I think it's just total, I don't know, but like, it seems kind of hokey. I don't really understand the zero knowledge proof stuff. That seems kind of interesting. And like, it could really have an implication because if you could have decentralized ledgers that had all the trades that would go into an ISDA, probably makes sense if we can figure it out eventually. So, I'm kind of bullish on the tech. I think I try to hold 1% to 2% crypto. If it gets up too high, I sell. If it gets down too low, I buy. But I'm not the person you want to go to ask for like crypto advice.
I think that's very responsibly put. The ZK proof thing, it feels like there's only like a handful of people in the world that really understand it anyway. So, and everybody else is just kidding themselves.
It makes me feel bad about it though. It's like, oh, I don't know what's happening with 0K proofs.
Yeah, exactly. Well, look, Alex, that was a really, mind expanding conversation. Really enjoyed touching all the different worlds of that. It's it's rare to have a guest on there where we could just journey into the micro components of what's been going on in some carry trade in Japan and go into the AI future. So I really enjoyed it.
Thanks for having me. It was really fun.
Yeah, awesome. Thanks, Al.